Okay, today let's talk about the biggest tax mistakes LLC owners make. But look, I get it, right? Because taxes aren't as sexy as making more sales and generating more revenue, or even doing stuff like building up your team and putting systems in place. Like, those are some of my favorite things about being a business owner as well. But here's the truth, okay? It's not always about how much top line revenue you earn, but rather about how much money you keep, which means you need to pay close attention to your net income after tax. So in this video, I'm going to reveal the biggest tax mistakes I see business owners making all the time. I'll take a look at what the most popular mistakes are, how to correct the mistakes, or even better, make sure they don't happen at all. And if you stick until the end, we'll look at a framework for managing your tax situation. Stay tuned. Hey there, and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And if you don't mind lending a helping hand, please hit the like button below to help this video reach more people like yourself. All right, let's dive in by first explaining, number one, what it means to be compliant with the Internal Revenue Service, aka the IRS. Now, the first thing you should know is that under Title 26 of the Internal Revenue Code, it allows the IRS to conduct what is known as a compliance check on you. Okay, these checks help determine whether or not a taxpayer is adhering to record keeping and information reporting requirements. Now, just to be clear, a compliance check is not, I repeat, it is not an investigation or an audit. Rather, it is a tool to help educate taxpayers about their reporting requirements. Now, during a compliance check, the IRS will review information the taxpayer is required to file or maintain, such as filing 1099 forms, filing W-4s or W-2s, and then filing 940s and 941s, and making sure you maintain those records. Now, if the IRS wants you to go through a compliance check, you should know that you can refuse and there is no penalty for not participating. That being said, not being compliant is the biggest tax mistake any business owner can make. But let's go a little bit deeper with mistake number one: too many cash transactions. Look, it's not illegal or make you not compliant with the IRS if you have cash transactions. But if you are constantly receiving cash or paying with cash, it makes it much harder for your business to keep and maintain the proper financial records. For example, when you are using a lot of cash for qualified business expenses, then you have to keep track of and likely organize all your receipts from that merchant, because during tax time, what you're going to want to do is write off those expenses to reduce your taxable income. And you need some type of paper trail of receipts or documentation to be able to substantiate your tax deduction. Or if you are using a lot of cash to pay other people like your contractors, then you're going to need to manually log and have your workers sign off on each transaction and each payment, which is just another hassle. But again, this is something you want to do so that you can write off your contractor expenses and save your business on taxes. On the other hand, if you are receiving a lot of cash payments, well, of course, that makes it difficult for you because now you have to manually keep track of all the cash payments you are receiving and make inconvenient trips to the bank if you want to store your cash safely. Now, also, you should know that one-time large cash transactions that exceed $10,000 may be flagged at your bank and need to be reported to the IRS through Form 8300. Which makes handling a lot of cash transactions even more difficult. Now, some people, for whatever reason, think that they can avoid taxes by using cash. But think again, okay? What I like to remind people of is this, okay? Your income is usually someone else's deduction, and your tax deduction is usually someone else's income. Okay, so what exactly does this mean? Well, for example, if you pay someone with cash, then that's an expense to their business. And unless they just want to pay extra taxes, then they will write off that expense. And vice versa for you, right? Like, if you pay someone with cash, you still want to reduce your taxes by writing off that cash payment, such as your contractor wages or your office supplies. And of course, the IRS can reference the tax returns and see that this company is writing off an expense related to your company. Okay, so then how can you correct or avoid this mistake? Well, this one is pretty easy, okay? You should, number one, consider setting up a business bank account where you have a digital ledger of all your transactions. And number two, when possible, you should use your business account or your business debit card or your business credit card when you purchase qualified business expenses or receive payments. All right, let's move on to mistake number two. No system for bookkeeping. Too often I see new business owners operating from their personal accounts, which creates a big mess at tax time. But look, I get it, right? Because you're ready to launch your business. The money is already in your personal account. So why not just use that for right now? But listen, as a business owner, it would be nearly impossible to know exactly where your business stands financially without segmenting your business and personal finances. So again, make sure you get your business bank account set up, but don't stop there. You need to understand business metrics for yourself, such as what products or services are driving the most sales, what your biggest expenses are and where you can cut back if you need to, how profitable the business is by looking at your net profit margins, and what your assets and liabilities are, which help determines the overall business worth. So how can you correct or avoid this mistake? Well, what you want to do is set up a system with consistent bookkeeping that happens, in my opinion, at least every quarter. Now, the bookkeeping system that we use and recommend is QuickBooks. QuickBooks Online can integrate with your business bank account, which allows you to import all your transactions. Then you can go inside QuickBooks and categorize things as needed. So I'll go ahead and put my affiliate link to QuickBooks where you can sign up and get started. Also, Crystal has a great video breaking down how to use QuickBooks for bookkeeping, which you can check out after you finish this video. So with consistent bookkeeping in place, you can take the time to actually, review your business financials each and every quarter. Plus, it's going to help you maintain compliance with the IRS by having good records and completing the necessary tax forms. Also, if you have any questions about this or anything else in this video, please ask them in the comment section below. Okay, let's move along to mistake number three, not paying quarterly estimated taxes. Here's the thing, okay? When you work for someone else as an employee, your taxes are automatically withheld and paid by your employer to the IRS and state agencies throughout the year. So for most employees, this is why they pay little to no taxes when tax returns are due. But for business owners, it's a little bit different. Since you are the employer and the employee of your business, you need to make sure you are paying taxes quarterly throughout the year. The IRS basically prefers to get their money throughout the year than at the end of the year when you file your taxes. Okay, these are called quarterly estimated tax payments. And if you don't make these quarterly tax payments, then the IRS is going to assess big time penalties and interest on the tax that you owe. This can easily be thousands of dollars. Okay, on the screen right now is a schedule of the deadlines for quarterly estimated payments for the 2022 tax year. Now, how much should you pay in quarterly estimated payments? Well, it depends on your taxable income. Now, there is a form called 1040-ES that helps you calculate what you should pay in quarterly estimated taxes. But a simpler method that I like to recommend is simply paying 110% of the prior year's tax quarterly. So for example, if your tax liability was $10,000 last year, 110% of that would be $11,000. So you can break up that $11,000 by 4 quarterly payments and pay $2,750 per quarter as your quarterly estimated tax payment. So how can you correct or avoid this mistake? Well, if you happen to make this mistake for the first time, you can call the IRS and ask for a one-time forgiveness waiver. When you do this, the IRS may waive what is known as the estimated tax penalty. And in general, the IRS allows for this one-time forgiveness every 7 years. So it's something that you can't keep doing again and again. And of course, to avoid this going forward, continue to make estimated tax payments by mailing a check or going to the IRS website to make a payment. Which brings me to mistake number 4, not preparing employee or contractor taxes. So now that you understand how to take care of your taxes, now you need to focus on how to manage your employee or your contractor taxes as well. Let's take a look at contractors first. So a contractor is someone who works for you according to their own process and schedule. So if you have a contractor and you pay them more than $600 in one tax year, then you should be issuing them a 1099 tax form. By doing this, you are able to substantiate and write off your contractor expense for your business. In addition, the contractors then take the 1099 form and use it to report their income on their taxes, which is also great for the contractor in the case that they need to get approved for a loan or when they buy a car or a house, so that they have some records of the income that they made. Now, you can set up contractors and pay them right inside QuickBooks as well. And remember, my affiliate link is down in the description below. Now let's quickly look at employees. So employees are people who work for you, and you are able to control the manner in which they work and their schedule. So when you have an employee, as we mentioned, then you are the one who are responsible for withholding their taxes. The first step in doing this is that the employee must complete a W-4 form to indicate to you as the employer how much taxes they want to be withheld. Then you would submit that to your payroll, which, by the way, QuickBooks has a payroll component as well. And with that, you can withhold the appropriate amount. And then at the end of the year, the employees will receive a W-4 form to report their income and substantiate your expense. Also, if you provide services for your clients, then they may hire you and consider you to be contractors for them for tax purposes. So they may send you a 1099 form as well to report on your business taxes. All right, moving right along to the 5th big tax mistake LLC owners make. Number 5, not filing business taxes. A popular saying is this: the only things that are certain in life are death and taxes. And yet, I don't know why, but almost every tax season, I run into business owners who have failed to file their taxes for multiple years. Everything's all right, nothing to worry about here. But listen, if you made income and you owe taxes and you failed to file your tax return, then you're going to face serious penalties and interest, which makes your tax liability much larger. And at the same time, it puts you on the radar with the IRS. And even worse, if you are found not to be compliant and you owe taxes, then the IRS can put a tax lien on your property or assets. But look, I promise I get it, because being a new business owner is difficult enough, and having to worry about all the tax things that you need to do can be a struggle. However, taxes don't have to be difficult at all. In fact, I have structured this video to where if you avoid the mistakes before this one, then when tax time comes, it is as simple as just entering in your financial information, answering questions, and then sending your tax return to your federal and state government. So then how can you correct or avoid this mistake? Well, again, if you happen to make this mistake for the first time, then you can call the IRS and ask for a one-time forgiveness waiver. That may help waive all the interest and penalties. And of course, to avoid this mistake going forward, you need to make sure you are filing your taxes on time each year. Okay, the 6th big tax mistake LLC owners make is number 6, not tax planning. Okay, the major problem with tax preparation is that it is not proactive. The goal of tax preparation is not to reduce your tax liability, but rather the goal of tax preparation is to make sure you file your tax return correctly and take advantage of as many tax deductions or credits that you qualify for based on what happened last year. On the other hand, tax planning can help you create more tax deductions or tax credits based on the current year. Now, as an entrepreneur myself, I am constantly looking at the costs and the ROI of doing different things, and tax planning is no different. So for me, if I wanted to invest in tax planning, then it needs to be worth my time and my money. Now, luckily, with tax planning, there is an actual ROI, which, by the way, ROI stands for return on investment, because tax planning is one of those things where you can spend money and actually get money back. Which, by the way, if you need help with tax planning, then consider working with our team by clicking the link down in the description below. Okay, let me explain this further by looking at two scenarios. Okay, scenario number one is a tax preparation scenario. So let's say, for example, you earn about $100,000 in net income or profit, and as a result, you owe about $15,000 in taxes. Well, with tax preparation, your cost would look something like this. Okay, you would have a tax payment of $15,000 plus $1,500 to pay a tax preparer for filing your business tax return. So your total costs are $16,500. And if you don't plan, then you could end up paying the same cost again next year. So that's scenario number one. Now let's look at scenario number two with tax planning. So with tax planning, let's say that you're able to identify in the next tax year, you will owe $15,000. And because you know that, you start proactively trying to implement tax strategies now to help you reduce your tax burden. But you're busy, so you decide to hire a tax professional to help you for $3,500. And that tax professional is able to help you save $10,000 by implementing different tax strategies. Well, with tax planning, your total cost would look something like this. Okay, you would have a tax payment of $5,000 instead of $15,000, plus a $3,500 tax planning fee and a $1,500 tax preparation fee. So simply by tax planning, you were able to bring your total cost down from $16,500 to $10,000. But that's not all, because now every year going forward, you're going to be able to save at least $10,000 without paying for another tax plan. So the next tax season, your total cost will be even lower from $10,000 to $6,500. So before tax planning, you were paying $16,500 every tax season, and after tax planning, you are now paying $6,500 every tax season. That's a potential lifetime savings of $10,000. So what would you do with an extra $10,000? Tell me in the comment section below. But here's an option for you, okay? What if you decided to invest the extra $10,000 and got a 7% return over the next 30 years? That would turn into $1 million. So the true ROI of tax planning is crazy. Now let's move into number 7 and look at a tax framework to pull everything together. So when I start a new business, this is how I set up my taxes. Step number 1 is I keep track of all my records, both physically and digitally, with bank accounts and digital documents stored on my computer. Step number 2 is I perform bookkeeping with QuickBooks. Step number 3 is I make my quarterly estimated tax payments. Step number 4 is I set up employees and my contractors on QuickBooks or on payroll. Step number 5 is I perform tax planning. Step number 6 is I file my business taxes, and then I repeat this cycle every year. All right. I hope this video helps you out going forward. If it did, please don't forget to like and subscribe. Now, we have 2 more videos coming up next that you may enjoy as well, so make sure you check those out if you haven't already, and I'll see you over there.